Did you know the rules around your bank account may be changing in ways most people never notice until their money is already frozen? I'm not talking about a small fee, a new app update, or some fine print buried in a statement. I'm talking about the kind of banking rules that can get your withdrawals delayed, your transactions reported, your business activity questioned, and in some cases, put you in serious legal trouble for moving your own money the wrong way. Most people hear about the $10,000 bank rule and think, that's for criminals. That has nothing to do with me. But that's exactly why ordinary people get caught off guard. Retirees, real estate investors, small business owners, contractors, landlords, and everyday families are walking straight into banking red flags without even realizing it. And today, I'm going to show you the 5 biggest changes you need to understand. The mistakes that can make your money look suspicious even when it's completely legal. And the protection moves I would use so you don't accidentally put your own account at risk. Before I give you the 5 changes, you need to understand the frozen number. The $10,000 rule was created decades ago, back when $10,000 was a very different amount of money. Back then, $10,000 could represent a major purchase. Today, $10,000 might be a used car, a contractor payment, a roof repair, a small renovation budget, or one real estate assignment fee. But the number stayed frozen while the cost of everything else went up. That means normal people making normal transactions can get pulled into the same reporting system that most people assume is only looking for criminals. And this is where a lot of innocent people make their first mistake. They think the report is the problem. It's not always the report that hurts you. It's how you react to the report, how you structure the money, and whether your activity looks like you were trying to hide something. Let me make this real. Imagine you've banked at the same place for 10 years. Your paycheck goes there, your bills come out of that account. They know you. Then one day, you walk in and ask for $12,000 because you need to pay contractors for materials on a renovation. Suddenly, the tone changes. The teller gets quiet. A manager comes over. They start asking questions. What is the money for? Who are you paying? Why cash? Why today? You didn't do anything wrong, but now you feel like you're being treated like a suspect. That moment right there is what most people are not prepared for. And if you panic, get offended, change the amount, or decide to come back tomorrow for a smaller withdrawal, you may have just made the situation worse. The first change is what I call the senior freeze problem. On paper, it sounds like protection. Banks are being pushed to watch for elder financial exploitation, scams, coercion, and unusual activity involving older customers. And of course, we all want our parents and grandparents protected from scammers, but in real life, that protection can turn into frustration fast. Picture a retired couple who saved their whole lives and wants to buy a car in cash to avoid high interest rates. They go to the bank, ask for the money, and instead of getting access to their own savings, they get pulled into questions that feel personal and embarrassing. Did someone tell you to withdraw this? Are you being pressured? Did you meet anyone online? Are you sure you understand what you're doing? Now imagine being completely sharp, completely aware, and still being treated like you need permission to spend your own money. If the bank is suspicious, they may delay the transaction while they review it. And here's the part that matters. From the bank's point of view, freezing first can feel safer than approving something and being blamed later. So you need to prepare before you walk in, not after your money is already delayed. The second change is the structuring trap. And this is the one that can hurt people the most because it feels logical until you understand the risk. A lot of people think, well, if $10,000 causes attention, I'll just move $9,000 today and $9,000 tomorrow. Do not play that game. If you intentionally break up transactions to avoid a report, that can create a much bigger problem than the original transaction. The money can be completely legal. It can come from a business, a house sale, a family gift, a car sale, or years of savings. But if the pattern looks like you were trying to avoid reporting, the issue becomes the pattern, not the source of the money. This is where ordinary business owners get scared. A restaurant owner making deposits. A landlord collecting cash rent. A contractor getting paid in installments. A small shop owner depositing weekend revenue. You may think you're being careful, but the bank system may read it as suspicious. And once that suspicion starts, you may have to prove what should have already been obvious, that the money was yours and that it came from legitimate activity. The third change is the digital payment net. A lot of people think cash is the only thing that gets attention, so they move everything through apps. Venmo, Zelle, PayPal, Cash App, online transfers, crypto, payment processors, business platforms. But digital money creates records too. And when personal payments and business payments are mixed together, your life can get messy fast. Your neighbor sends you money for a used lawnmower. Your cousin pays you back for dinner. A tenant sends rent through the wrong app. A client sends a business deposit to your personal account. One transfer may not feel like a big deal, but a year of mixed activity can create confusion, reporting issues, tax questions, and a paper trail that does not tell a clean story. The danger is not just that digital payments are visible. The danger is that your records may make personal money look like business income look undocumented, and innocent transfers look like something you now have to explain. The fourth change is Form 8300 and the pressure it puts on businesses that receive large cash payments. This is where people accidentally create problems with contractors, car dealers, jewelers, attorneys, repair companies, and other businesses. If a business receives a large cash payment, that business may have reporting obligations, so when you try to pay a contractor in cash or split up a large payment to keep it quiet, you are not just affecting yourself. You may be creating a reporting issue for the person receiving the money too. And because penalties can be serious, businesses may become extra cautious. That means they may ask for more information, refuse certain payment methods, or report transactions you assumed were private. So if you're paying $12,000 for a roof, a renovation, a vehicle, or a major service, don't assume splitting it into smaller pieces makes it safer. In many cases, that is exactly what makes it look suspicious. The fifth change is the software. This is the part most people don't see. Banks are not just relying on one teller's opinion. They have systems watching patterns, repeated deposits, repeated withdrawals, payments just under a threshold, multiple accounts, fast money in and out, cashier's checks, wires, app transfers, unusual activity compared to your normal behavior. And the scary part is that the system does not need to know your whole story to flag you. It only needs to see a pattern that looks unusual. You may have a perfectly good explanation, but if the explanation is not documented, you may be stuck trying to prove it later. That's why the goal is not to hide. The goal is to make your money movement boring, clean, documented, and easy to explain. Now let's talk about what to do, because I don't believe in just scaring people. I believe in giving you moves. The first protection move is to pre-notify your bank before a large transaction. If you know you're going to withdraw or deposit a larger amount, call ahead. Speak to the branch manager if you can. Tell them what the transaction is for, when it's happening, and what documentation you have. Ask them if there is anything they need from you so the transaction goes smoothly. This does not guarantee nothing will happen, but it does one powerful thing. It creates context before the system creates suspicion. When a human reviewer sees a note, an invoice, a purchase agreement, a closing statement, or a legitimate reason attached to the activity, your transaction is easier to understand. The second protection move is simple. Stop accidental structuring. If you need to move $12,000, don't turn it into two $6,000 transactions just because you're nervous. If you need to deposit $15,000, don't break it into $7,500 and $7,500 to stay under a number. If the money is legitimate, move it in the cleanest and most direct way possible. The report is not automatically the enemy. Looking like you try to avoid the report is what can create a bigger issue. So don't get cute with your own money. Be clear, be direct, be documented. The third protection move is to use cleaner payment methods when possible. For major purchases, business transactions, real estate, vehicles, and large contractor payments, consider methods that create a clear record. Wires, checks, closing statements, invoices, escrow, and proper business payment channels can be easier to explain than a stack of cash. Cash is not illegal, but cash can create more questions. If you are buying property, funding a deal, paying a contractor, or moving money for a business purpose, you want the transaction trail to tell the story without you having to panic later. The fourth protection move is to separate your personal and business money. This is where so many people create problems for themselves. Do not run your business through your personal payment apps. Do not take client money into the same account you use for groceries, birthday gifts, and dinner reimbursements. Have a business bank account. Have a business payment processor. Keep personal payments personal and business payments business. When everything is mixed, your records become a puzzle. And when the bank, the IRS, or anyone else has to solve a puzzle, they may not solve it in your favor. The fifth protection move is documentation. Documentation is your shield. Every time you move a larger amount of money, keep proof. Save the invoice. Save the receipt. Save the contract. Save the closing statement. Save the bill of sale. Save the text or email that explains the transaction. Write down the date, amount, source of funds, and purpose. You don't need to be paranoid, you need to be organized, because if your account is ever delayed, questioned, frozen, or reviewed, the person with clean records has a much easier time than the person trying to explain everything from memory. And for older adults, there is one extra move that matters. Set up a trusted contact or banking authorization before there is a problem. Many banks allow you to add a trusted person they can contact if they are worried about fraud or exploitation. This does not mean giving someone full control over your money. It means creating a safety channel so the bank has someone to call instead of immediately treating every unusual transaction like an emergency. If you are over 60 helping a parent or managing family finances, ask your bank what options they have for trusted contacts, pre-authorization notes, or fraud prevention preferences. Do this while everything is calm, not when a car is waiting, a contractor is demanding payment, or your account is already under review. Here's the real lesson. The banking system does not care that you are a good person. It cares about patterns, thresholds, reports, and risk. So you have to stop moving money emotionally and start moving money strategically. Don't hide, don't split transactions to avoid attention, don't mix personal and business payments. Don't rely on memory, don't assume your bank understands your life just because you've been a customer for years. Build a paper trail before you need it. Make your transactions easy to explain. And when you know a large move is coming, prepare your bank, prepare your documents, and prepare your records. The $10,000 rule is not going away. Reporting is not going away. Digital tracking is not going away. If anything, financial systems are becoming faster, more automated, and more sensitive to patterns. But that does not mean you have to live scared. It means you need to be informed. When you understand the rules, you stop making innocent mistakes that look suspicious. When you document your money, you protect yourself. When you separate your accounts, you protect your business. When you communicate before large transactions, you reduce friction. And when you stop trying to outsmart the system, you stop giving the system a reason to question you. So before you move another large amount of money, ask yourself 3 questions. Can I explain where this money came from? Can I prove what this money is for? And does the transaction pattern make sense to someone who knows nothing about me? If the answer is yes, you are already in a stronger position than most people. But if the answer is no, slow down and clean it up before you move the money. Because in today's banking world, it is not enough for your money to be legal. It needs to look legal, trace legal, and document legal. That is how you protect your wealth, protect your family, and keep control of the money you worked so hard to earn. Thanks for watching. Have a wonderful day.